So today we're going to talk about the bond market. We'll understand what bond basically is. We'll also try to explore related terms to bond like yield and yield curve. And to sum up the conversation, we'll try to figure out why and how the bond market predicts recession before everyone else. Right? So, what we have observed over the past decades, we have seen that during the 2000.com crash, the yield curve inverted before the bubble burst. Inversion of the yield curve signaled the housing collapse. So basically, warning flashed before any global shutdown. So this particular example makes it very important and makes you realize how much bond market is important to understand the underlying indicators that are leading you towards recession, right, which are signaling you towards recession. Most people ignore it, but one market kept, that is a bond market, it kept sending signals in the same message, right? So let's try to understand what exactly a bond is. See, let's take an example that government needs money. Where could it get money? Right? Of course, taxes and everything is a stable source of income for the government. But let's say, for example, they want more money than they're having right now, right? For any particular reason. Don't focus on that. So government need money. What they can do is they can issue a bond. A bond could be an IOU or a loan in terms of it's irrespective. So basically what you do is you lend your money by buying that particular bond, right? When you buy that particular bond, what could happen? Let's say the face value of that particular bond is, let's say, 100 rupees, right? The government could either give you, let's say, at the rate 5%, and the time could be 5 years. So what this basically means is every year, so you buy the coupon here for 1 2 3 4 5, you will get 5 rupees every time, and at the time of maturity you will get your 100 rupees back. This 5 rupees that you are getting every year is basically the coupon rate, the coupon payments. This 100 is basically what you invested. So when the government releases bonds, basically you buy it for the face value, you get a particular coupon, and then after maturity you get your principal back as well as you get yearly coupons, right? Coupon payments. Now this is not the only scenario. There could exist zero coupon bonds. The problem with, not a problem, but how these bonds work is basically the face value would eventually be 100 rupees but 0% coupon. So why would someone buy this? See, what happens is, give it, what government or any organization or corporation could do is they can give you this face value 100 bond for, let's say, rupees 90, and it could mature in about, let's say, 1 year. Okay, let's say 1 year, right? So what will happen after 1 year? You will get rupees 100 back. You bought it for 90. You when you redeem the bond, you get 100 rupees back. So this 10 rupees difference is what compensates for the coupon payments, right? This timeline could be anything, 5 years or anything, and this rate would eventually change, right? So a bond is simply a loan. You give money today, government promises interest payments plus return of principal later. So we have to first understand what yield actually is and how we calculate it. It's as simple as it could get, right? Let's say the face value of a government bond is 1000 rupees, right? The coupon payment, the government is saying that we will give you 50 rupees per year. So what is the yield? Yield is a very simple formula. Annual interest, whatever you are getting, that is 50 rupees divided by the bond price. Bond price was 1000. You get 5% yield. That is yield of a particular bond. It depends on the face value, the price, as well as the coupon payment that you are getting every year. Your yield is simply the return you earn divided by what you initially invested. As simple as that, right? So why different bonds have different yields? Longer loans are tend to be more risky. See, why is that the situation? See, we can see the government usually gives out bond for 1 year, 10 years, 30 years, or multiple years. It could be as short as T-bills could range from 3 months, 9 months, etc. But bonds can usually be from 1 year, 10 years, and 30 years. See, when you're giving out loan to someone for 30 years, you can't really make sure that the same position of the company that is today would be maintained or grow over 30 years. You can basically make an assumption, understanding the forces behind the company or the government. You can make a prediction for 1 year, but not 30 years. A lot of things could escalate or descalate over the period of decades, right? So longer loans usually come with more risk, right? So first let's talk about inflation risk as well. See, what will happen in this particular thing is, let's say you bought a bond of 100 rupees for timeline of 30 years. You'll get, let's say at the rate 10%, you will get 10 rupees for 30 years, right? And at the end of 30 years you'll be left with 100 rupees. You won't be left with 100 rupees, you will get 100 rupees back. But you have to understand the time value of money here, right? Those 100 rupees after 30 years won't have the same purchasing power as it has in today's environment, the economic environment, right? Prices tend to increase if there inflation, right? So understanding how inflation and how much inflation would grow after 30 years, and is 100 rupees getting back worth after 30 years, right? Getting 100 rupees back plus the coupon payments of 10 rupees, you are getting 110 at the end of the year. That's a good, pretty decent investment, right? After 1 year, you're getting 100 back, but you also got 10 rupees coupon, so that ultimately somehow tends to make sense, right? But getting those 100 rupees or maybe 10,000 rupees, 10,000 rupees today might have a greater purchasing power value rather than what it would have after 30 years, right? So when you have to make a decision where coupon rates as well as the principal that you're getting back, we also take into factor the price of the bond, right? And then you make an informative decision. To do that, we use something called the YTM, right? YTM currently is not related to this particular topic, so I'll be covering that in a different video. But when all these factors, the coupon, the purchasing power, the price at which you buy, and the principal that you will get back, that is covered in YTM. So interest rate risk, maybe committing yourself to a 30-year bond which might not be as liquid as you might think. Maybe you could get, after maybe 5 years, you could come across a bond that is giving, let's say your 30-year coupon bond is getting giving 5% interest rate, right? Maybe you could get a bond after 5 years that is giving 7% interest rate, right? So interest rate is always a risk because rates could change anytime, which affects the bond value. We'll also understand this particular interconnection between the rates as well as the bond values further in the presentation, right? This obviously economic uncertainty, right? The economy could look very different decades later, right? We are not sure about the economy after maybe 1 year, right? We could make predictions after studying the underlying forces, but again, doing a prediction for 30 years is something that is not at all possible. A lot of things can change within 30 years. New technology, new expectations of the people, modernization, everything could happen, right? So now we have understand the concept of yield. So let's move forward to the yield curve, which is very important, right? Because remember, it signaled about financial crisis before they happened, right? So it is very important for you to understand about the yield curve. So what basically happens is, again, the 1 year bond has less risk, so return is less. A 10-year bond as compared to 1 year bond would have higher risk, so higher return. Right? The longer the maturity, the higher the yield. This is perfectly normal. Longer loan pay more. Right? So normal yield curve is upward sloping. We'll see the yield curve in a second. In healthy economies, long-term bonds yield more than the short-term bonds. Read this line again. In a healthy economy, long-term bond yield more than the short-term bonds. Right? Now, this is what a yield curve looks like. See, when we're talking about 1 year, the interest rate is 3%. When we are talking about 2 year, it could be approximately 4 or 3.5%. For 5 years, it could be 4.5%. Right? For 10 years, it could be approximately 5%. For 30 years, it could be 6%. Right? So, this is the time for maturity, right? And this is the interest rates, right? So why bond prices and yields move oppositely? Let's try to understand this. See, what happens in scenario 1? You have a bond that gives 100 rupees per year, right? The price of the bond is 1000 rupees, right? So earlier formula was interest that you are getting, the coupon that you are getting, divided by the price, that is 10%. Now let's say, see, you have a particular bond. Let's say it is giving you 10% coupon payment, right? But there comes a bond in the market that is giving you 7%. Which bond is valued more? Of course, this one, right? So what will happen is, people would try to get their hands on this particular bond and not this, right? So when demand for a particular thing rises, prices increase, as simple as it could get, right? So prices of getting them, see, bonds could be transferred, right? If there's enough liquidity and people want to explore their choices, people can trade in bonds. Someone else would get those payments. It is transferable, right? So let's say this exact scenario happened. The coupon was 100 rupees per year. This would remain same. But now what you are doing, for the same price has now doubled and became 2000 because of the increase in demand, because other bonds are giving less coupon payments than this particular bond, right? So what will happen is, 100 rupees would remain same. Coupon depends on the face value. If the price could be 10,000, the coupon is still fixed on, see, this price is not equal to the face value. Be very clear about it, right? At the end, even if you buy it for 10,000, that particular bond, if it says face value of 1000 rupees, you will get 10,000. You won't get 10,000, you will get only and only 1000 rupees back, right? Whatever the face value says. So in this scenario, the yield eventually becomes 5% only, right? So same coupon payments, but because of price, the yield, because price doubled, yield actually eventually became half, right? Yield fell. So bond prices and yield move in opposite direction. Where demand for bond rises, prices increase and yields eventually decrease. It's as simple as that. It's basic maths. So the moment the bond market gets scared, when does it get scared? At micro level, if we look at, people become worried about the future. Uncertainty rises. What happens in the middle is, the pension funds, insurance companies, banks start buying long term government bonds, right? Because they believe in the long term things could eventually become average and the uncertainty could be avoided. At the macro level, trillions flow into bonds, prices rises because demand rose, yields fall dramatically. Now connect the dots. What is happening? People are worried about the future and the uncertainty rises. Right? There's a whole new demand for long term government bonds because whenever we look at the long term trend of anything, we can see either a growth or things averaging out. So it tends to become more safer than the short term because of the volatility. See, a shift is happening. Before we were saying that the short term was much more less risky than the long term. But because of uncertainty, things have changed. Things are starting to change. Now the current scenario is looking very unpredictable and uncertain. There is a lot of volatility. People want to opt for safe havens like the long term government bonds, right? So the bond market is collectively voting for with trillion of dollars, right? The most important section is now the inversion, right? So what basically happens? Normally what happens is for 1 year we are getting 3%, for 10 years we are getting 5%. But now what happens? For 1 year, because there is low demand, there is more uncertainty, the prices drop. So the 1 year bonds tend to be cheaper, hence giving more yield. And now there's a demand for long term government bonds like 10-year bonds, right? So when the demand rises, the price rises, so basically the yield drops. Now short term pays more. We were seeing an upward trend. This is the maturity, this is the interest rates, right? What was happening? Short term was less, long term was high. But now inversion, longer maturity is giving less, but shorter is giving more. This is because of the demand and pricing relationship, right? So why does this happen? Central bank raises short term rates to fight inflation. What it basically does is they increase the interest rates of short term, right, to make it more appealing, right? So people tend to invest in those bonds because they're getting, see, higher risk but higher reward. These are risky but you are getting high reward. When people are okay with it, they must be investing in that particular asset, right? It's all about your risk appetite. So what eventually happens is investors fear recession, right? They rush to buy long term bonds, which is a safe haven, right? So increase in demand increases for long term, hence the yield falls. What is happening? Short term rates have increased, they are looking more appealing, but there is uncertainty in the market. So long term bond prices rises, long term yield fall. Result is short term yields are less than the long term yield, which causes the inversion. This is basically the inversion. As you can see here, we are seeing an upward trend here, but that tends to go down, and this is a signal, right? So let's understand about the signal in terms of spread. 2-year treasury bond giving out 6% interest and 10-year treasury giving out 4%, right? So spread would essentially be 10-year yield coming back to normal. Risk is high, so return is high, right? So this should be a bigger figure, right? But what is happening? This became a smaller figure due to demand and pricing. 2-year bond, which is supposed to be less risky, hence reward are less, ultimately becomes more yield generating. So there is a negative 2% spread, right? A negative spread is equals to a yield curve inversion. Inversions have preceded almost every modern recession. When these things come into picture, this is a signal for economic distress, right? Why this precedes recession, right? We have to understand the chain reaction behind it. See, central bank raises rates, the borrowing cost rises, right? We have understood about this particular scenario in previous videos, and if you have not, please refer to those videos to understand it more deeply. Consumers and business are borrowing less. This is also covered in the previous videos, right? When consumers and businesses are borrowing less, their spending power decreases. So spending eventually slows down because people are not ready to buy. So there would be no enough investments. If there are no consumption, no spending, no investments, eventually the GDP function, that is consumption plus investments plus government spending plus exports minus imports, everything is slowing down in this particular scenario, right? So eventually the economic growth would slow down, and the slowing of economic growth is what is recession. So the risk rises sharply, right? Now this is the chain reaction you should talk about when anybody asks you about bond market and recession, right? So let's talk about some historical case studies here, right? So yield curve inverted from 1998 to 2000. It's not something that happens in a day. Banks, the central banks, be it RBI, be it the Feds, they are not just uh, changing interest rates every single day, or nor they are changing it 2 to 3 to 4 to 5% at a time. It happens slowly. Maybe 0.5% increase, maybe 0.5% decrease, maybe 0.25% increase and decrease. That also triggers a market in its own way, right? 0.25% difference is also an indicator. There is no such value which is small, right? Recession followed in 2001. We experienced this, the yield curve inverted in 1998 to 2000, and recession came in 2001, in which the tech stocks crashed 78%, the dot com bubble, right? Inversion happened in 2006 to 2007. The housing bubble burst, banks collapsed, and the Great Recession began. Then come the then comes the COVID. Brief inversion in 2009 when it eventually started. Pandemic hits, markets crashed but recovered faster than expected. Right? But now, see, this. We saw a trend. It is just a trend, it is a signal. Whenever yield curve inverts, it doesn't tell you that at that particular day, in this particular time, there is going to be recession. No, it is just an indicator, a warning, right? The yield curve is a warning, not a prophecy. There could be false signals. Inversions can occur without immediate recession. Timing is uncertain. It doesn't comes in with a stamp of time after which it's gonna come, and it doesn't give you a certainty that it's gonna come. There are no exact dates. External shocks. Recession can happen for unexpected reasons, like the COVID-19 reaction, right? It could happen because of wars. It could be because it could come because the policies were not strong enough to supplement the current economic situation, right? But despite everything, it is still one of the best indicators that have some historical accuracy across the decades, right? So coming to the modern reality, Why the bond market sees further? The bond market essentially contains institutions which are managing trillions. See, people who are investing in bonds are investing everywhere as well, especially the institutions. They are investing in central banks, pension funds, insurance companies, hedge funds, wealth funds, and asset managers. These are basically the institutes who are actually actively present in the bond market, right? They are placing huge bets. These are the institutions, right? These institutions spend enormous resources forecasting growth, inflation, and policy. They're not just randomly playing on speculation, they're actually basing their decisions based on the growth, inflation, and as well as the policy. The yield curve is the collective intelligence of the world's most sophisticated investors, which are again the central banks, pension funds, insurance companies, hedge funds, wealth funds, and asset managers. Right? So, why the yield curve works? It's not a magic, it's just a collective belief. When investors believe growth will weaken, they tend to go towards the long term bonds because things tend to average out in long terms, which are why it long term bonds are called the safe havens, right? So long term bond prices rises and yield eventually falls, right? uh, should I just bring back the formula? Calculating yield involves the coupon payment about and divided by the price you invested, right? When the prices increases, coupon remains the same, and yield decreases. The yield curve inverts. The yield curve isn't predicting the future; it's revealing what the smartest money already believes about the future. The stock market votes, the bond market investigates. It is showing you the exact picture of how interest rates, who are dependent on the economic environment, is making the yield inverted or as it should be. Right? So let's come back again to the formula. Yield is basically nothing else but the annual interest rate divided by the prices of bond. Spread is nothing else but the 10-year yield minus the 2-year yield. If it is negative, then it's an inversion. You don't have to draw the graph anytime, right? Real yield. What is real yield? Real return or real yield is basically something that is inflation adjusted. This formula is not only for yield, it is for return. Real means it is adjusted for inflation. If the nominal yield is, let's say, 10% and inflation is 5%, then actual real yield is 5%. Right? So the relationship between price and yield is basically when the price rises, yields tend to fall down. When prices falls down, yields tends to increase. So an inverse seesaw based relationship, right? So to understand more hidden signals about it, I hope you are understanding what I'm trying to do here. You can take a look at my previous videos. I'm explaining a lot of concepts regarding the markets, about the RBI, about financial terms like margin calls. So take a look at my channel and subscribe if you are really interested for the deep dives and how I'm talking about these particular topics. Also, you can drop the topics of your interest in the comments, and I'll make sure that those topics are eventually covered. Thank you so much.